Why don't I kick things off? I'd like to thank Burnie Maybank for joining us today to share his wisdom on a subject that I would contend he's the foremost expert in this state on. So we're honored to have him, and Burnie, thanks again.
Good. I'm here today to talk about economic development incentives, which is very often overlooked and is typical of my speeches. I figure a fair percentage of y'all are interested in one topic but not another, so I've crammed a whole bunch of different topics into it today. Hopefully something will catch your attention. I know some of y'all are not personally interested in the topic, but someone in your office may be, so I brought hard copies. And to the extent you want to forward them to somebody, just email me, and I'll send it to you on an email. I have 3 listservs, and I'll preface by saying they're not for everybody. One is for economic development, and I send an email on it almost every day, and so we all get too many emails. So, but if economic development interests you, just so I do a lot of 50-state rankings, and I'm not a cheerleader for South Carolina. I send the bad stuff as well as the good stuff. The second one I have is state and local taxes, and I suspect probably none of y'all want to get an email every day on state and local taxes, but I have that. And the third is realtor/real estate development. One virtue of being on the listservs is we do seminars each year. We do probably 2 economic development seminars a year. We used to do 3 or 4, cut back to 2. We had one just 2 weeks ago at the State Farmers Market, so it'll probably be 6 or 8 months before we do that. Our seminars are all free, and we actually throw in a lunch. And then for economic development, each year we do a state and local tax seminar. We always do that in the October time frame. It includes, for lawyer types, it includes an hour of ethics and an hour of mental disability. That credit ain't always easy to come by. And so we encourage people, if state and local tax doesn't interest you, you can just come after lunch and get your hour in ethics and your hour of mental distress or mental disability. And then on the realtor side, we do about 4 realtor seminars a year, certified by LLR. Realtors have to get real estate credits, just like lawyers do. And the realtor seminars are very similar to economic development seminars. They focus on economic development incentives for commercial and manufacturing in South Carolina. So just if any of those listservs interest you, just email me. We have a bunch of economic development incentives, a bunch of exemptions and credits. One reason we have them is our base rates are so high. Our tax rates in South Carolina are extreme. We are one of the lowest in the country, which we are for example, for the property taxes on your primary residence. For years, we were one of the lowest in the country on fuel taxes and still are. For years, we were one of the lowest in the country on cigarette taxes and still are. Or one of the very highest. So the property taxes on manufacturers outside of exemptions, we're the highest in the entire United States. So when I was Director of Revenue and I gave my speeches, I'd say, we're not amongst the highest, we are the highest. For things like documentary taxes, for example, which y'all will run into when you file a deed, I saw ABA sent out a little 50-state survey, and I quickly glanced at it. We were the 2nd highest documentary tax rate in the United States. We are like 5th on the sin tax side. We're 5th or 6th highest on wine, 6th or 7th highest on beer. We have a marijuana tax, but we don't have a lot of compliance with that one. So I don't know where we fit on that. So we're the very lowest in the country, or we're the very highest. Now, by virtue of being the very highest, the lobbyists each year come in, businesses come in complaining, and so the General Assembly typically doesn't deal with the rate because that's got a direct revenue impact, and so they don't deal with the rate. What they do is every year they'll put in new exemptions, new credits, new deductions to knock the effective rate down. And so that's one reason we have so many. Just on the documentary tax side, the DOR annually does an updated publication on documentary taxes, so which you pay when you file a deed. It's like 37 pages long. 37 pages long. Because we have so many exemptions, deductions, various ways to calculate it, some of which are very pro-taxpayer. It can be very complex. The first thing in deciding whether or not you're entitled to an incentive is what kind of business you are. And our incentives in South Carolina don't break the bank because so many people who are entitled to them never use them. They might break the bank if everybody figured them out and started using them, but they don't. But to decide what incentives you're entitled to, the first thing you have to decide is what kind of business are you. And this is true, by the way, not only for South Carolina, but the great majority of the states. So you're either a manufacturer or you're a service. And service is just commercial businesses. We also have in South Carolina, I was chairman of the Enterprise Zone Committee, which awards a wonderful incentive, which I'll get into. And so many white collar businesses were not manufacturers, warehouse distribution, et cetera. But we finally came up with the criteria of qualified service related facility. It is basically white collar jobs. It's every white collar job, but about 5 different things: lawyers, accountants, stockbrokers, that kind of thing. So if you're a qualified service related facility, you're treated, you qualify for the incentives. But typically, you're one of those 3. Now, we do not have a definition, but we have a very modest definition of manufacturer in the code. It basically says you take a raw ingredient, you turn it into a finished product. And service commercials about everything else. Manufacturers are typically, the easiest way to classify them is by your NAICS code. So NAICS classifies businesses by manufacturing sectors, service sectors. So it takes about everything you do and tells you not whether you're a manufacturer or service. Well, and you declare your NAICS code on your federal income tax return. So what everybody does is the very first year they do the return, they put down the NAICS code that describes their business that day. And then years later, you're doing something totally different. You've never bothered to change your NAICS code, and therefore you're sort of you're in the wrong category. But that's the first thing you got to do when we talk about incentives. Are you a manufacturer or not? Or not meaning commercial/service, and in some cases, your qualified service-related facility, which gets you a lot of advantages of the incentives. So there's a pro and a con. Manufacturers pay much higher property taxes than commercial, but they enjoy numerous sales tax exemptions and they enjoy numerous income tax credits. They have a slower depreciation on their machinery and equipment than commercial, and they pay much higher property taxes. Commercial has much lower property taxes, significantly lower property taxes, but they have very few sales and income tax credits or exemptions. So a lot of times, I'll be honest, there are businesses that are manufacturers for some purposes and not manufacturers for other purposes, i.e. property taxes. And they just hope, that the law doesn't catch up with them. And that typically happens when small manufacturer, you start off as R&D. And then one day, you hit home run ball and bam, you're actually manufacturing and selling something. You're probably leasing from commercial office space. The dealers never picked you up, so you're taxed as commercial. As a practical matter, you're taxed through your landlord, property tax through your landlord, and hopefully you're filing a business personal property tax return. And then one day you start selling the product, and the dealer never catches up with you. And the landlord doesn't turn you into the assessor. But one day you're going to want those sales tax exemptions. So at that point, you have to turn into a manufacturer. Qualified service-related facilities, there are typically service businesses. They're not manufacturers. If you're a manufacturer, you don't need to be a qualified service-related facility. So a qualified service-related facility is a non-manufacturer. It's a white-collar, basically any white-collar job that pays high enough salaries. And the advantage of being a qualified service-related facility, is you qualify for the tax credit. You qualify for the jobs tax credit and the job development credit. Now, you don't get the numerous sales tax exemptions, but you do get the jobs tax credit and the job development credit. And as a service business, your property taxes are going to be lower than manufacturing. Now, South Carolina we rank terribly on property taxes, and that may change. The only true 50-state analysis of property taxes, a sophisticated analysis, is done by the Lincoln Institute. There are others like Wallet Hub. Wallet Hub just issued one the other day, but Wallet Hub only focuses on your primary residence. Lincoln Institute is the only one that really focuses on manufacturing, commercial, primary residence, and second home. And so the Lincoln Institute issues their study every year, very sophisticated, very, very good. South Carolina is #1 in the country on manufacturing. And so what they do for all categories, residents, manufacturing, commercial, they look at one urban area, which is the largest city in the state, and they look at one rural area. So for South Carolina, since they've been in existence, they look at Columbia, and they look at Mullen, South Carolina. And for property taxes for manufacturing, they look at small, medium, and large M&E because some states tax small, medium, and large M&E differently. South Carolina does not. Some states do. So for Columbia, South Carolina, they have, for all 50 states, they have 3 categories of property taxes on manufacturers, small, medium, and large. And then they have 3 classifications for property taxes on rural and small. So there's 6 50-state property tax rankings on manufacturers. South Carolina is #1, highest in the United States for all 6. Now, everybody says, well, gee, Burnie, people don't actually pay that. They all get a fee in lieu, which I'll get into in a minute. The DOR says there's $8 billion worth of manufacturing property, which is not in a fee in lieu. And these are people like you, small, medium, and large. You started off as R&D, then you started manufacturing. You know, I ain't gonna pay Burnie for that, for a damn fee in lieu. I ain't gonna do that. Well, what's the alternative? Highest property taxes in the entire United States. For commercial property taxes, we're also quite high. We're 7th in the country for commercial property taxes for small facilities and 9th highest for large. So commercial property taxes are quite high in South Carolina too. Now for residential, we are one of the very lowest in the country. We're 49th. Lincoln Institute does 53 taxing jurisdictions. They do the 50 states, Washington, D.C., New York City, and Chicago. So we're 49th, the lowest one of the lowest in the country. And it's a waterbed effect as the General Assembly is constantly pushing down primary residence taxes. It bumps it up for everybody else. Literally everybody else, their taxes go high. We had Wallenhud said we are 48th in the country for car property taxes. And that's after we actually did a constitutional amendment 10 years ago to lower car property taxes. So we would be by far the highest, but for that amendment. Boats and planes, we are undoubtedly the highest in the United States. There's no 50-state breakout of that, but I did research on that back when I was the DOR director, and we're undoubtedly the highest in the country on that. So, well, we may get a lot better though, because Charleston's population now exceeds Richland County, exceeds the city of Columbia, and so hopefully Lincoln Institute next year will focus on Charleston and not Columbia. And so the millage in Charleston is considerably lower. In Richland County, what you have, the Richland County millage is almost identical to the Charleston County millage. The city of Columbia millage is almost identical to the city of Charleston millage. The school district in Richland County is vastly higher than the school district in Charleston County. And so the combined millage, which is what Lincoln Institute looks at, is much higher in Richland than it is in Charleston. So we may, in next year's Lincoln Institute study, we may, if they look at Charleston instead of Columbia, we may do a lot better. But one reason I focus on how tough the taxes are in South Carolina is to tell you, is just to make you think about incentives. One day you'll be in a position to get them. The other one is very gloomy, is called Location Matters. Location Matters is published by the Tax Foundation and KPMG. They quit publishing it, and I called them. They used to do it annually, and they haven't done it since 2016. And I called them, and they said, "Damn thing's so expensive. KPMG is so expensive, we can't afford to do it anymore." But they looked at retail and warehouse and distribution, and they looked at new facilities and mature facilities because sometimes the tax is different. They also, unlike Lincoln Institute, they looked at all taxes, property, income, sales, even unemployment insurance, for example. So for a retail facility, South Carolina was the highest in the entire United States. Highest in the entire United States. And for warehouse and distribution, we were second highest. We were 49th. And as I often point out, this study is not anti-Southern. every state around us was vastly lower. Not like you were picking on South Carolina, because we don't like labor. All the states around us were significantly lower than South Carolina. So there's a way to combat all of that, and the way to combat all of that is through incentives. So we have discretionary incentives and non-discretionary incentives, and as you can imagine, discretionary incentives are a lot better. No surprise there. Um, grants are typically paid to counties. The flow through of monies is a check goes to the county, and then the county spends it as per what the grant says. So you have three major funds: the Economic Development Set Aside Program, Rural Infrastructure Fund, and the Governor's Closing Fund. The majority of those dollars are actually used for public infrastructure. If you're a manufacturer, warehouse, and distribution, and you're going to a greenfield site, there's undoubtedly going to be needed road, water, or sewer. So they would pay for that, the manufacturer, the warehouse, or distribution would. But they also pay, in rare instances, they pay for brick and mortar. They do not pay for machinery and equipment. But if you're doing a $60 million manufacturing facility, they might give you anywhere from $500,000 to a couple of $1 million for your bricks and mortar. Under the federal income tax, the new federal income tax law change, that's now taxable at the corporations. That's a change in the law has been for 80 years. There's a Supreme Court decision almost 80 years ago that said grants to corporations for economic development purposes are not taxable, and the new federal law changed that. So those discretionary incentives are highly competitive. The Department of Commerce looks at two things. They look at have a question? They look
I'm sorry, go ahead. You can finish.
They primarily look at the capital investment and the number of jobs. And so you sign a grant document, and there's clawbacks in there, and typically you have to hit a certain investment threshold, and you have to hit a certain hiring threshold before Commerce will give you a major grant. Now, smaller grants are, $50,000, $75,000 grants are obviously more lean. But that's actually hard dollars. It's not nearly as read in the paper. The NERV, I don't know if any of y'all are familiar with the NERV. The NERV is a Tea Party website. When the right and the left go so far around, they're all against corporate welfare and the like. The NERV ran a story on it just the other day, just within the last couple of days. About these mysterious grant funds that nobody knows anything about. Well, the Coordinating Council publishes an annual report, which is on their website. It's readily available, the grants that they give. And you don't have to know the grant minutiae. Really, in their position, Commerce's position is none of your business where the funds come from. They'll just write a check. But obviously, those grant funds just go to the very largest project.
Yeah, that's sort of, tickling around where my question is what are some of the other, criteria to be eligible to receive these? Do you have to be in the state a certain amount of time?
No.
Do you have to be in a certain amount of revenue? I know you said two of the criteria.
Yeah, those are the major two. New companies, in fact, probably the majority of the funds go to companies that are not in South Carolina. That's not only not a requirement, probably the majority goes to companies who moved to South Carolina for the first time.
Yeah.
So they require, as part of your application, you have to give detailed financial documents, but they're really weeding out the startups, and they're really kind of covering themselves. So public companies would just present a 10K or a 10Q. I represent Michelin, which is a private company, and Michelin never liked to give their financial records to anybody, but they had to give them to Commerce. So they're really kind of weeding out the startups, and startups are not going to get a grant as a practical matter. So the grant document will require typically one of two things or both. They'll always require a capital investment, and sometimes, but not always, they'll require jobs. Those are the two. And then, of course, you get weeded out if you're unionized, for example. You're not going to get to that stage. You're a horrible polluter. You declared bankruptcy 2 years ago. You're just not going to get to the stage. of getting the grant. The second discretionary incentive, which is a very good one because it's the withholding tax credit. Now, we have a whole bunch of income tax credits. Manufacturers in this state, rightly or wrongly, have very little corporate income tax liability. So all of the credits and exemptions, which we'll briefly get into, means very little to manufacturers because they don't have an income tax liability. They don't really care about income tax credits. By contrast, this is a withholding tax credit. Well, who has a withholding tax liability? The Catholic Church has one. The federal government has one. Virtually everybody has a withholding tax liability. So withholding tax credit is far, far more valuable. I actually wrote the statute with Doug McKay. I don't think you all know Doug, a million years ago. And South Carolina was only the third state in the country that give. All the other states were concentrating on incentive. So it was all, when we first passed it, that was under Governor Beasley. It was all the rage. Now a lot of states have copied us. But it's a 10-year incentive. And so you sign a contract, and one of the two reasons we did the contract route was if the General Assembly in the height of a raging recession were ever to repeal this incentive under the contract clause in the South Carolina Constitution, your incentive would be locked in. So if you were in year 2 of the incentive and the General Assembly repealed it, they would just be repealing it going forward. You would be entitled to your 8 years of incentive. The other thing the contract does is, provide clawbacks and requirements and stuff of that nature. So it's as a practical matter, you've got to have 30 new jobs before Congress is going to give it to you. So that's as a practical matter, you're talking about 30 new jobs and up. The credited amount is a percentage of your withholdings, of your payroll, and it ranges from 2 to 5%. Mostly now, no, but the 2% really doesn't apply. So if you get the incentive, you're looking at 3 to 5% of your payroll for a 10-year period. The very largest project did it for a 15-year period. As a practical matter, you're looking at 10 years. So to get it, you have to be a business of the type that qualifies for the jobs tax credit, and I'll get to that in a minute. But as a practical matter, manufacturers, warehouse, distribution, and qualified service-related facilities qualify. You have to provide a benefits package. And so so that's the major. It's highly discretionary. As a practical matter, if you don't have 30 or more new employees, Congress is not going to give it to you. Here's a definition of qualified service-related facility. So we did this. I was chairman of that committee, and we just beat to death. I can't believe you're not going to get the incentives to the software companies, who pay far more than manufacturers do. And so what we did was we wrote in the statute qualified service-related facility. So if you have 175 jobs at a single location, you qualify. It doesn't matter what you do. As I mentioned, there's 4 or 5 entities that don't qualify. You go to 175 jobs, law, accounting, a few things like that. So 175 jobs, doesn't matter what you do, you qualify. 100 jobs where you pay 1.5 times more than the lower of the county or the state. 50 jobs, twice the lower of the county or state. 25 jobs at 2.5 times the lower of the county or the state. And then you see at the very bottom there, that was a lobbyist touch for a building that burned down. Well, they could building in that case. So 2.5 times the lower of the county is tough because all of y'all want to move into Charleston, Lexington, Richland, Greenville. Well, Charleston's per capita now is $23 an hour. And it's the lower. So the state's per capita is around 16 now. So hopefully you can hit that. One of the biggest problems when we get the job development credit is you have to pay at or above the average county wage. Now that's not the lower of the state or of the county. When I was chairman of that committee, that was the rule we had, the lower. Well, they changed that after I left. Now you have to pay at or above the average county wage. So in Charleston, very few manufacturers And no warehouse or distribution ever qualifies for the job development credit because they're not paying what, 23 bucks an hour or more. And even in the very glamorous manufacturing jobs, and you can quickly figure out who they are in Charleston. You know, there are a lot of people make $23 and more, but a whole lot of people don't. And so it's not nearly as lucrative to them. So the DOR annually publishes the average county wage. And that's the hard part on job development credits. You got to pay at or above the average county wage. You have to do an application, and that requires a bit of lawyering, but not much, and a $4,000 application fee. And you have to submit it before any official announcement. If you have an official announcement before you apply, you're totally out of luck. You're not going to get it. Now the $4,000 fee seems a little high, and the lawyer's a little high. As a practical matter, as part of your negotiations with the state, Commerce will tell you, we're going to recommend you for this program before you stroke that check. The only people who ever pay the $4,000 are those that are going to get it. And I was chair of the committee for 7 years, and we never once turned down a project that Commerce had said we will recommend it to you. So as a practical matter, you're not stroking that check or hiring a lawyer until you've already been assured you're going to get it. The credit amounts depend on, and I won't get into the minutiae of this, but the credit amounts depend on what county you're in. So in the rich counties, you get 55% of the maximum credit. And here's the tiers. These numbers are updated annually. That's why they're so funky specific numbers. So if your employees are paid between 1611 and 34 bucks, you get 4%. That's 4% of the payroll, the entire payroll, every year for 10 years. So a major manufacturer, you're talking about real money. The use of the credit, the vast majority of and I always refer to this to my clients, it's really not the use of the credit, it's the credit cap. So the credit cap is for the vast majority of businesses acquiring and improving real profit. So the typical manufacturer, they spend $40 million on their facility, they're not going to get anywhere close to the job development credits of $40 million, $2 billion. So they never ever have to worry about the cap. The person who does have to worry about the cap is people like you. And we had one client, it's because when you lease property, the lease generally does not count as acquiring or improving real estate. And personal property doesn't count. So if you you lease an office space and you bought $2 million worth of computer equipment, your cap you'll never hit. I mean, your cap is zero because you haven't acquired or improved real estate. You're moving into a swanky building. You might spend a little bit of money improving it, but not much. And your computers don't count. So your cap, your cap is zero, so to speak. And so that's the lease is a terrible problem. We had one company going to hire 200 people, pay about 60 grand a year to each of them, and they were leasing space and whined and complained, pushed and lobbied. They didn't get it. They didn't get it. And the reason I refer to it as didn't get it, the lease is not in a statute. That's Commerce's rule, and so they can waive it. And they have talked about liberalizing that from time to time. There are other ways to do it, but white collar never is any of these categories. So it's highly competitive. They only award it in appropriate cases, typically 30 jobs or more. Average county wage can be a real problem, even in some rural counties. If you're on a lake, Saluda, for example, we kind of think of Saluda as a more rural area. Well, they're not. They're on the lake, and there's all these retirees there. The average county wage in Saluda is quite high. And then leases are an issue except for build-to-suit. Now, if you do a lease in a build-to-suit, that counts. But it's where you lease existing property that you're going to have a real issue. So that's the job development credit. Other issues, reimbursable expenses only includes real property expenditures. M&E and computer equipment don't qualify. And you got to be a type of business, manufacturers, warehouse, and distribution, and qualified service-related facilities qualify. Then we have Ready SC. We call it discretionary, but it's for every manufacturer, it's automatic. Now, in y'all's world, I don't know the automatic, but for manufacturers, they get a very good free train. One of the best in the US.
They have to be for full-time jobs.
I'm sorry?
The training has to be for full-time
Right.
jobs. It can't be for town hires.
Right. And the sort of the bargain is you tell them how many you want to hire, they'll screen, and screening nowadays is the big deal. You get 100 you put your criteria out, you're going to get 100 resumes that obviously don't meet the criteria, but people are sending them in anyway. So they'll screen it out and they'll train them, and then the deal is you'll hire them after they do all of that.
I understand one of the bigger issues is finding people who pass the drug test.
Oh, I know. One company, I don't know if it's an urban myth, I think it's true. We told one company, hey, you got to quit the hair screen and go to the urine screen. Or you're never going to hire anybody. I had one client, height of the recession, they knew they would have to lay off, and then they would have to pay a huge unemployment tax. So they did a surprise drug screen, figured that was going to get rid of a lot of people because you don't have to pay unemployment tax. And to their horror, everybody passed the drug test. Couldn't believe it. Couldn't believe it.
Get a new lab.
One of y'all know he's very prominent. I won't give it a name, but he said they had to quit doing drug tests because his best employees were failing with them. So they just quit doing them. So that's it for Ready SC. It's a extremely good program. Then we'll shift over to the income tax credit. So we just went over grants, which is hard dollars. And we just went over job development credits, which are hard dollars because everybody has a withholding tax liability. So it's a withholding tax credit, but it's comparable to hard dollars. Now, the income tax credits are frequently referred to as soft dollar credits. Our credits are not refundable. So you got to have a tax liability to use them. We have a 5% corporate income tax rate. It's actually one of the lowest in the Southeast. North Carolina now has a lower corporate income tax. North Carolina's income tax rate now is 3%, which is the lowest in the country for states that have a corporate income tax. 5 or 6 states don't have one. But it's become less valuable to companies. We have 100% single sales factor apportionment. And what that means in so many words is the only income that's sourced to South Carolina, which is then subject to the 5% rate, are sales to South Carolina customers. So the vast majority of manufacturers, they're not selling a whole lot to South Carolina customers. Like an example of Michelin or BMW, they'll have some, but that's a very, very small percentage. So if 1% of Michelin sales are South Carolina customers, only 1% of their income would be sourced to South Carolina, which would then be subject to the 5% corporate income tax rate, and they would have the numerous credits and deduction. Now, South Carolina, that's the rule, called 100% sales factor. That's the rule for manufacturing. It's been like that for about 8 years now. For service businesses, the DOR is quietly taking the same position. Now, the reason they're taking that same position is a lot of service companies sell into South Carolina that don't have physical presence. So the DOR wants to tax them. So they've gone to what is in essence 100% sales rule for service businesses. Now, where that is, and I've got several very large computer software clients in the state, and I keep telling them this, I don't think they're listening to me, but the only income they should be paying taxes on in South Carolina is sales to South Carolina customers, just like manufacturers. Typically, in the past, they would source almost 100% of their income to South Carolina because that's where their facilities are. We call that the cost of performance rule, and that's been the law in South Carolina, for forever. But now, if you're a computer service business, You're not selling tangible personal property, you're selling services. Don't pay income tax on anything but sales to your South Carolina customers. And sometimes that can be a very small number for y'all as well. We have a jobs tax credit. The jobs tax credit, you have to do several things. First of all, you have to be a specific type of business, and you have to create and maintain 2 full-time jobs at the time the facility is opened or staffed. So there's a long list of businesses that qualify as qualifying businesses. It's manufacturing, tourism, South Carolina's relatively rare. Lots of states have jobs tax credit. Hotels qualify in South Carolina. Warehousing, distribution, R&D, and qualifying service-related facilities. So under the traditional jobs tax credit, and I'll get to the small business jobs tax credit in a minute, you have to hire and maintain 10 new jobs. So the amount of the credit ranges from $1,500 to $8,000, depending on the county in which the jobs are located. Now, in y'all's case, probably every single one of y'all are located in a tier 1 county. The richest counties are 12 richest counties in the state. So the credit amount is the $1,500. If you're in Williamsburg or a poor county, it's $8,000. Now that's a credit, not a deduction. The difference being a credit is a dollar for dollar reduction of the check you would otherwise stroke to the Department of Revenue. Also, being a service business, you have tax liability. Manufacturers don't have tax liability for a variety of reasons. Most service businesses do. So the jobs tax credit is a lot more valuable to you than it is to a manufacturer. And then we have the credit is earned for 5 years. So each year for 5 years, if you create and maintain the 10 net new jobs, you're getting another $1,500 per employee for a 5-year period. And then we have the longest carry forward, undoubtedly the longest carry forward in the country. What the carry forward is, if you can't use it the first couple of years, you just carry it forward until that hopefully one day will come when you have a tax liability. Virtually all of the federal income tax credit carry forwards are 3 years. Ours is 15 years, and that's got to be the longest in the country. And a lot of businesses, they don't have a tax liability today, so they don't bother to, and they don't see one for a couple of years, so they don't bother to claim it. Well, you given up that down the road if you don't claim it today. Now you can go back and refund. I mean, you can go back and file amend your return and file a claim. So let's say you've got 5 employees and then 10 and 12, 14, 18. Then you hit the home run ball, you hire 50. Well, your base is 18. Whereas if you had filed it a long time ago, your base would have been 10. So you want to file it as soon as you hit the 10, because that establishes your base, and therefore the new employees, you're going to get a lot more new employees. Occasionally when I give this speech to larger employers, manufacturers types, they said they'd never heard of it. They've not been claiming it. And so you can go back and file amended returns for 3 years to claim it. So I encourage them to claim it even though they don't have a tax liability in those years, because it lowers your base number of employees. We have a small business jobs tax credit. And the reason this isn't a huge revenue impact is nobody has ever heard of it. So if you're manufacturing, processing, warehouse distribution, or qualified service-related facility, and you have fewer than 99 employees worldwide, then you just have to create 2 net new jobs. So if you are a law firm in Williamsburg County and you hire a secretary and a paralegal, you've just created $16,000 worth of income tax credit by doing it. Tier 4 counties, any business qualifies. You don't have to be manufacturing, warehouse, distribution. So in Williamsburg County, law firms qualify for it. And so it's a wonderful program. The amount of the credit depends upon how much you're paying them though. So you either get 100% credit or a 50% credit amount. And so for all of y'all, it'd be 100% of $1,500 per employee or $750 per employee. And, but if you pay them enough, you actually get the 100% credit. If you pay them a little less, you get the $1,500 credit.
Bernie, these are all W-2 employees.
I'm sorry?
These are all W-2?
Right. Yeah. The only people don't, and it's got to be not only W-2, but you got to work year round. The only person, the only exception for seasonal is agriculture.
Bernie, what does it mean by creating a monthly average of 2?
It's incredibly involved. I issued a policy document because I got so many questions when I was at DOR. I told my staff we have got to have a policy document defining exactly what you just said. And the policy document is 76 pages. And so it gives you lots of examples. And the reason it's complicated, well, gee, what if you hired in February? You know? Or what if they quit in March and you rehire in April? So it goes through every scenario known to man. The easiest example would be you hire 2 on December 31st and they're there 2 years later. That's 2 net new jobs. The other reason, just to be blunt, why y'all all want to do this is one day you're going to sell the company and they're going to be more valuable to the purchaser if you've got these big credit carry forwards, even though you're not using them, the purchaser might. And then, your creditors, your board might wonder, why the hell haven't we been claiming these?
And these have the same 15-year period?
Yeah, small business does indeed. There's an investment tax credit. This is typically applicable just to manufacturers. It's very similar to the federal investment tax credit. There's an R&D credit, and in y'all's world, again, you want to claim this even though you don't have any tax liability whatsoever. Probably all y'all have R&D, and if you qualify for the federal R&D, and what I tell my client, if you qualify and you're taking it on the federal side, you qualify it on the state, no questions asked. Don't even worry about it. Again, this is all news to you. You can go back and amend your return for 3 years to claim that. Sales and use tax rate.
The R&D, back to the R&D. What about the carry forward on that?
That is 10 years. So it's a lengthy carry forward too.
Oh, there, sorry.
Sales and use tax rate. South Carolina has a fairly high sales tax rate, 6% and local option. There's a whole bunch of exemptions for it. These are the exemptions for manufacturers. These are typical across the country. South Carolina isn't particularly better than in other states for manufacturers. One area that we were better, for example, in North Carolina up until a year or two ago, is we didn't charge sales tax on electricity to manufacturers. North Carolina did. But there's a long list of sales tax exemptions. Manufacturers just don't pay a whole lot of sales tax. Warehouse and distribution pays almost all of those, however. And so that's, again, a good example why you want to be a manufacturer. So the machine exemptions in South Carolina, almost every state with the sales tax has a machine exemption. Electricity is exempt, coal, coke, and fuel for manufacturing is all exempt. Material handling systems and construction materials, those are huge, can be huge savings, but those are the very largest facilities. I'm sure none of y'all are involved in that. Then property taxes, I'm running out of time, so I'm going to quickly start going through this. To understand the incentive, you've got to understand how property taxes are calculated outside the incentive. So we have an equation with 3 variables: fair market value times assessment ratio times millage. Now, South Carolina is not unique in having an assessment ratio. A lot of states are not called an assessment ratio, but a lot of states have the equivalent to it. Our assessment ratio is actually in the Constitution. And the reason we have an assessment ratio is to take the property tax burden off the voters and shift it on to everybody else. And that's how we're able to do it, is through the assessment ratio. So fee and lieu is the major property tax incentive. It has, for manufacturers, it has a very valuable. For commercial, it's not quite as valuable, but it still has some value. So fair market value outside of fee and lieu is what the assessor is for commercial and what the DOR says for manufacturing. Inside a fee in lieu, it's the original cost locked in over the life of the fee. And that's a horrible disadvantage to a manufacturer because manufacturing plants tend to rapidly decline in value. But if you had a beautiful, gleaming Class A office building in Mount Pleasant, locking in the value would be a good thing. So assessment ratio, that's the middle part of the middle variable. They're actually found in the South Carolina Constitution. Manufacturing is currently at 10.5%. As part of the gas tax bill that passed last year, it's going down to 9% over a 4-year period. Commercial personal property is 10.5%, but commercial real property is 6%. Warehouse and distribution real property is 6%. Residence is 4%. Farm, non-corporate farms are 4%. So the assessment ratio for manufacturers outside of fee and lieu, it's 10.5 on the real and personal property, and M&E is huge for a manufacturer. Inside, it's down to 6% on both the real and personal property, and most counties they could give you 7%, but they just would have 6% of the rest. Then village outside the fee and lieu, it said annually there is a tax cap, but it invariably goes up, but actually can go down for reassessment years. Inside a fee and lieu, it's frozen for the life of the fee. So that alone, it makes paying a few shekels to a lawyer for a fee and lieu worth it. 30 years from now, you're going to be paying today's bill. That savings alone makes it a good idea to do a fee and lieu. You can't do existing real property in a fee if it's already been subject. If a building has already been subject to traditional property taxes, you cannot put it into a fee. You have to do a minimum investment of $2.5 million. That's what the statute requires. You've got 5 years to hit the $2.5 million. This is discretionary purely with county council. So in Charleston and Greenville, they're not going to give you a fee for $2.5 million, but a lot of other counties would. So the advantages of fee to the taxpayers, it reduces assessment ratio. So for commercial, it doesn't reduce the assessment ratio of the real property because commercial is already at 6%, but the business personal property is reduced from 10.5% to 6%. So for a warehouse and distribution facility, they've got a huge amount of business personal property, and that's very valuable to them. If you did a commercial office building in it, the commercial office building has very little business. And I've done a number of fees for commercial property. Some counties will cheerfully do one for a hotel or an office building. So it eliminates rollback taxes. If you bought property taxed as agricultural in South Carolina and virtually all those states, you have to pay 5 years of the tax differential. So as rollback taxes, if you take farm property and convert it to something else, the fee and lieu, the rollback taxes are eliminated. And then lastly, you freeze the tax millage, and that alone makes the fee worthwhile. There's some disadvantages. Sometimes there's a clawback that freezes the fair market value of the real property, which is a huge disadvantage to manufacturers. Multi-county special source credit. Basically, county council has the only say in this. The school district has no say. County council can match the tax rate of anywhere in the world if they want to. So I represented Berkeley County when the first Google facility came in. Google convinced Berkeley County and the state that we were either going to do the project in New York or Berkeley County. They convinced us that if they did it in New York, they wouldn't have to pay any property taxes on their computer servers, and therefore we gave them 100% special source credit on their computer servers. So we matched the state of New York's property tax rate. Manufacturers and payments automatic. Manufacturers don't pay property taxes for 5 years of the county portion of the village if they're not in a fee and lieu. Pollution control equipment, the home run ball, is totally exempt. There's the Textile Facilities Revitalization Act, Retail Facilities Revitalization Act, which is now sunsetted, and abandoned facilities. So if you take a building that has been vacant for 5 years or more, you get a credit of 25% of your rehabilitation costs. And that's basically free money because a lot of times, to be blunt, those buildings are going to be renovated anyway. But all of a sudden, they get to take the credit of 25% of their rehabilitation costs under the Abandoned Buildings Act. There's actually a property tax credit, but most counties are not familiar with the act and they don't give the property tax credit, but it's a nice income tax credit. I'm gonna skip the impact of federal tax reform on manufacturers, but on the slides, I've gone into it in painful detail. One impact of it is grants and free land to corporations are now subject to federal income taxes for the first time in 80 years or so. So we have a time for a few questions. I guess we do. And feel free to ask questions on anything. It doesn't have to be just on what I covered.
Thanks, Bernie. Our company is a commercial real estate software company. We license SaaS application to commercial real estate brokers all over the country. Most of our users are outside of the state of South Carolina.
Right.
Some are in South Carolina. I have read through several DOR memos about sales tax on those licenses. None of them were 76 pages, thankfully. I can't quite figure out if we're supposed to collect sales tax.
The answer is that you're talking about sales to other states.
Well, no, sales to users in the state. I know if we sell them an application, they download it onto their machine, we definitely don't collect it. But that's not what we do. We sell them a license to use the service.
I just did a major research project for a software vendor in North Carolina, and some states sales of software for sales tax purposes are totally exempt. California, despite being so anti-taxpayer, is totally exempt there. And North Carolina has a bunch of exemptions as a practical matter is exempt there. By contrast, and I think Texas is all taxable. And Florida, I also looked at Florida and Tennessee. I think Tennessee is all taxable. And then in Florida, I think it was largely exempt.
I think it is largely exempt.
In South Carolina, there's about 4 exemptions, and they're extremely specific, more so than in other states. So database is a classic one, and the DOR has several long policy documents on what is exempt, and the DOR has updated it a couple of times as to because the law has changed a little bit. So it's the classic example in South Carolina and all the states is if you sell a can, it's subject to tax. Right. Nobody does that anymore. Right. But even on the internet, it can be subject to sales tax. So in South Carolina, Westlaw and the services you buy that basically just give you stored data back, like Westlaw, are subject to sales tax. Netflix, y'all don't see them, but they're buried in your bill. So Netflix and a lot of those programs are subject to sales tax. There's a communications why they're subject to sales tax. But software, you have to hit the data processing exemption. That's the big one. North Carolina has an exemption. Basically, if it's designed to run on multiple computers at the same time, regardless of whether it does run. I forget exactly how they describe that. South Carolina doesn't have that exemption. So in South Carolina, you have to see whether it fits the database exemption.
Our application is built on a database in the back end and users their data into the system. And a lot of data and spits it back out. I'm not sure.
So you'll see there's about 5 policy documents just on that.
A few of them seem to be conflicting too, and I can't quite figure it out. I never could quite get a straight answer. If I err on the side of not collecting, because for the few users we have, it's kind of a hassle in different counties, as you can imagine.
Yeah, you got the local option. The other way of looking at it, though, is that the customers would pay it without thinking about it. And if you don't charge it and you don't file a sales tax return, they can go back forever. So you want to file 0 returns.
I do file 0. I do file 0 returns.
That gets the statute of limitations running. If you're in a gray area, it's generally better to charge the customers because they don't care. Now, in the internet and retail world, they care very much, but in your world, they don't care. So sometimes it's better just to go ahead and charge it too. If you'll email me, I'll send you the South Carolina policy document.
Okay, great, thank you.
I have one quick question. One of the tax credits that a lot of our clients use is the Angel
Uh-huh.
tax credit, do you see that continuing? I know there's been a lot of debate on whether that's going to.
It gets introduced every year, but I don't see it going anywhere really. I know when we first did it, it was almost fully subscribed right away, and you never heard another word about it. It was between us chickens. It was designed to promote South Carolina businesses, and there was some suspicion it went to a lot of non-South Carolina businesses. But it's not always crystal clear, what's the South Carolina business anybody. So I know it's come back up, but typically revenue impact is a reason that it doesn't pass. And then before you had a couple of senators, like Senator Rich, who kind of made it their life's mission. And you don't really have too many senators nowadays who kind of make it their life mission, so it's a little harder to pass.
I want to touch on your last comments there in terms of the federal tax law change and the taxability of grants. Can you define what is a grant?
The federal law, so there was a case solid 8 years ago where the Republic of Cuba gave a railroad company money to foster them to extend their lines. And the IRS said that's taxable, and the U.S. Supreme Court said it was not. So that's been the law for corporations since Cuba v. IRS 8 years ago. So the federal, we changed it in the law this year. One of the reasons I'm sure it was put in there was several articles, the rare people who thought, why the hell did they do that? What they had to do in order to get it, they knew no Democrat was going to vote for the bill. So in order to have it passed with 51 votes versus 60 votes, they had to have the revenue impact had to be at a certain level. So they knew all of the tax bennies they were going to give away. They knew the value of those. So they had to find something to bring that number down. And so they pulled that number, I think, they out of thin air just to pull the number down. So what the statute says is grants or free land given by a state or civic group. It does not define the term grant. I think most of us have a pretty good idea what a grant is. It also grandfathered in that same vein, though. It grandfathered developments in a master development plan. If you were a master, you can see the TIF lobbyist obviously got that put in there. But master development plan is not a term of art, and it's not in a dictionary. I just wrote a big article on the subject if any of y'all have any interest on this exact subject. And so what the District of Columbia very cleverly did is they passed an ordinance saying A, B, C, D, E, F, G are all master plan developments for purposes of federal law. Now, that's not binding on the IRS, but it's certainly helpful. So that the act doesn't define grant, but I think most of us would know what a grant was.
So we, SC Launch Program, give out grants. They're determined to be a state agency as per the state report. So therefore, ergo, it sounds like.
Well, it's not taxable to you, though.
No, I'm talking about to our recipients.
Right. The law has always been that was taxable to LLCs, and the compliance rate has probably been fairly nominal. Now, there are a number of exceptions to that. The taxation of it, which my article includes, and one of them is lack of dominion and control. One of them there's a notion of welfare, and remind me, and I'll email you my article that goes into 31 pages of mind-numbing protection. Okay, now the rest of you will email me for it.
I'll wait for the movie.
You got to make sure you're not paying income taxes on sales to anybody outside of South Carolina. And so what you see on the sales tax side, but the exact same concept, you've got a client that's 3 different states, one of which is South Carolina. You say, hey, bill me from North Carolina. And that's where the invoice is from North Carolina. So what irritates me, the reason I'm on a mission from God, I lost a case from an out-of-stater selling in. So I said, this is the rule. So if I'm a South Carolina software company, I don't have to pay a dime except on income to South Carolina Customs. And yes, DOR had to say that in order to prevail in my case. So I'm on a mission from God that everybody realizes the only income you source, and your accountant may not even be aware of it. It's not found in any DOR policy document, no statute. It's not on your tax return.
Did they issue a letter or anything?
I'm sorry?
Did they issue you a letter or anything in that regard?
The administrative law judge issued the opinion that I lost. And so I cross-examined them. And I said, and it's a matter of public record, I can tell you that the client was Dish. So Dish had 5.8 billion and 30,000 employees. So I said, so now Dish had $5.8 billion worth of investment in South Carolina, and 33,000 employees in South Carolina. They would only owe taxes on the 1.6% of sales to South Carolina residents. And they said, yes, absolutely. Any other questions then?
I just have a random question. So what is your perfect storm of a honey hole of a company when somebody comes to you and you see them and you're like, wow, you're going to get this tax credit and you qualify for X, Y, Z. What is that perfect storm type of company?
You need to, in order to get really you've got to have about 30 employees. And capital investment is not nearly as important. So in the software world, just a couple of $1 million. Now the reason y'all are not going to get big grants is you're not going to have public infrastructure needs. So the state's just not going to write you a big grant check. But 30 employees would get you the job development credit, and then you'd be entitled to all of the non-discretionary incentives that you mentioned. Which in y'all's world, just not that valuable. Now, one difference between software, you've heard me say 6 times, and manufacturers is y'all may have a big tax liability. So all these credits and deductions from income taxes that manufacturers who care less about become very valuable to y'all. And they're non-discretionary. You just claim them on your return. What I do on my smaller manufacturers clients, typically they'll hire me to do a fee in lieu, and I'll ask them to send me their last year's corporate income tax return, and almost invariably they have not claimed the investment tax credit, never heard of it. A lot of them use accounting firms in other states, and in fairness to the accounting firms, there's not much tax liability. They're not going to spend a whole lot of time and effort on it. Whereas in your world, y'all are going to have a tax liability.
We spent a little time talking about the high property tax on manufacturing entities.
No, the General Assembly ain't going to fix it.
All right. So part of what we're doing is drawing and increasing manufacturing sector. So wouldn't most manufacturing entities think about a separate sort of leasing side of the house to minimize the amount of income and then have the manufacturing side leased from the holding entity?
It's the use of the building, not the ownership that controls. So if a manufacturer rented a strip mall, it would overnight change from commercial to manufacturing. That DOR doesn't always pick that up. So for warehouse and distribution, and we changed the statute, used to be if the warehouse and distribution was contiguous to the manufacturing, it was taxed as manufacturing, even though it was warehouse and distribution. So what all the manufacturers did is they built their warehouse and distribution non-contiguous. So NOCO had the horrible case. They built their corporate headquarters, and it was like a $12 billion, $20 million, and that was back 25 years ago, and that was real money. They didn't think it was contiguous because a road ran between their corporate headquarters and their manufacturing facility. So they thought they would be taxed at 6%, and no, they were taxed at 10.5%. So they appealed it to the Supreme Court, and the Supreme Court said, I think it was a road and a railroad separating them, and the Supreme Court said that did not defeat contiguity.
Interesting.
Anything else? Bernie, thank you so much.
Okay.
Very interesting.
Thanks, Brian.